Hello and welcome back to All Things Money. I'm David Blain, your host. During this segment, we're going to continue speaking about the ebb and flow of investing style. Try to speak too fast. Last segment, if you missed it, we talked a little bit in the beginning about ZeekRewards.com. If you don't know what that is or not invested in it, that's a good thing because it was a scam. Scammed millions of people, hundreds of millions of dollars scam. And we introduced this topic of the ebb and flow of investment style. So if you missed it, head on over to the website, dlblain.com. We'll have copies of the show posted there in a week or so. Anyway, so we're talking about Jeremy Grantham, who's one of my favorite people to listen to. He's been on Wall Street for a long time, got a lot of knowledge, talks about the ebb and flow of investment style. And the reason that I want to talk about this today, we had a meeting with some of my favorite clients, and they were talking about, they were a little bit upset about some of the investment performance of globally diversified portfolios the past couple of years have been having, a little bit of a hard time, that the market has been largely driven by Apple in the U.S., technology stocks, high quality, blue chip type companies. And, small caps, commodities, the rest of the world's kind of been left behind. And so we had this great discussion talking about investment style. And a couple of years ago, I'd written this piece, which I want to read some to you. You have to bear with me. The first thing is a quote from Jeremy Grantham. Once again, he's an investment manager, been around since the 70s, manages almost $100 billion of investment. And he says that 90% of what passes for brilliance or incompetence in investing is really the ebb and flow of investment style, like growth versus value, foreign versus domestic, etc. Since opportunities by style regress, past performance tends to be negatively correlated with future relative performance. Therefore, managers are often harder to pick than stocks. Clients have to choose between fact, which is the past performance, and the conflicting marketing claims of various managers. As sensible businessmen, clients usually feel they have to go with the past facts. They therefore rotate into previously strong styles, which regress to the mean, doing most active clients to failure. That's the end of the quote from Jeremy. And a couple things I want to highlight. It's just a great synopsis of what people do incorrectly. Number one, 90% of what passes for brilliance or incompetence is the ebb and flow of investment style. That's so key. The majority of investing has to relate to the style. And so when you see people on TV touting, gold or, U.S. stock or emerging market or whatever, and they have the hot thing, it's simply due to the ebb and flow. Gold was hot for a while. Bonds have been doing very well. U.S. large company has been doing very well. Okay, so that's the first thing. Remember, 90% of investing is the style investing you're in, and these styles go in and out of favor. Number two is that most people rotate into the previously strong style, and which then turn around and become the poor performing style, and this is what dooms most clients to underperformance over long periods of time. So, for example, our style, which exposes clients to a lot of globally diversified multi-asset class portfolios, which is based on time-tested principles, is going to go in and out of favor at different times. And so some years and some quarters people say, oh gosh, you guys are so brilliant, you're doing so much better than the S&P 500. You guys are just, you're brilliant. Then other quarters or other years when the S&P 500 is doing better, they're like, wow, is your process broken, or what's going on here? It's very typical, but it's simply the ebb and flow of these investment styles. And the reality is we're doing exactly the same thing that we have been, which is a risk-controlled, diversified portfolio, minimizing the downturn and participating in most of the upside, rather than doing something wrong. And you see this in the institutional world, and any money manager or investment advisor that is operates as a fiduciary, certain principles, this is going to be the experience. And so these investment styles go in and out of favor, usually 3 to 5 years. For example, from 2003 to 2007, if you weren't all invested in emerging markets, you look like an idiot. If you were just in, the U.S., that's so passé. The returns of emerging, that's where it's at. China, Brazil, India, Russia, all the money was being made there. And who wants those U.S. companies? That was the style. And gold, from 2007, to 2009, gold. Man, if you didn't have gold chock full in your portfolio, you were just an idiot. You didn't know what was going on, that the dollar was going to collapse, and you need to have all gold in your portfolio. And then, since 2010, it's been, if you don't have Apple in your portfolio, if you don't have all these U.S. large companies, what do you mean you own European stocks? What are you, an idiot? So these styles go in and out of favor. We go back, large cap technology stocks, the late 1990s. It happens all the time. And Jeremy Grantham is just putting into words what exists in reality. And so what happens is investors get very discouraged after, 1, 2, 3 years of underperforming, the S&P or the Dow or emerging markets, whatever the bogeyman happens to be. And so they decide to dump their mutual fund or dump their manager. We see this in the institutional world even, where they change managers just at almost precisely the exact wrong time, is right when that style is hottest, and they rotate out of the style that's just about to come back into favor. Well, that brings us to our second break. When we come back, we'll finish up with this topic of the ebb and flow of investment style.